Good morning and welcome to today's edition of The Mint. We start with a topical story of the coronavirus, and Zimbabwe's tourism and hospitality industry has experienced significant postponements and cancellations following the COVID-19 outbreak. The outbreak of the coronavirus presents a major and dynamic challenge for businesses across the globe, but some European governments are considering the possibility of nationalizing large industries to protect them from a likely global recession. Now, while the effect of the restrictions will likely hit all sectors of business, the tourism sector presents a unique challenge, and the tourism sector, like no other economy activity with social impact, is based on interaction amongst people. And the World Tourism Organization (UNWTO) has strengthened its collaboration with the World Health Organization (WHO). And the two UN agencies met in Geneva to further advance a coordinated response to the coronavirus. On the backdrop of travel restrictions, tourism is currently one of the most affected sectors, and the UNWTO has revised this 2020 forecast for international arrivals. UNWTO estimates that in 2020, global international tourist arrivals could decline between 1% to 3%, down from an estimated growth of 3% to 4% forecast in early January 2020. Now, in a Zimbabwean context, the outbreak is likely to dent tourist arrivals projections for the country, which had initially been targeted at 2.9 million visitors for 2020. Tourist arrivals in Zimbabwe had increased to over 2.5 million in 2018, up from 2.4 million in 2017. Zimbabwe's tourism is estimated to have generated over $1 billion in tourism receipts in 2018, which was a growth of 7% from 917 million recorded in 2017. But how bad are the downstream effects of COVID-19 on the hospitality sector? We spoke to the Hospitality Association of Zimbabwe President Clive Chinwada, who gave us an assessment of the possible impact of the coronavirus.
Our industry is currently significantly depressed. We have got destinations that rely 80% on international travelers, inbound travelers coming from source markets such as Europe, Asia, and so forth. So if you look at Victoria Falls, for instance, occupancies are suffering, hotels are depressed. There is very little to zero activity. And even in the run-up to today, we had big events that were scheduled to be happening in Victoria Falls that have been cancelling, or that have been cancelled as a result of trying to mitigate the impact and effects of Corona coming into the country, as a result of the fact that people can't even travel because international flights are cancelling. So yeah, we up to today have lost quite a big chunk of our market. We have lost quite a lot of money as an industry. I would estimate it to be running into several millions of dollars that have been lost as a result of Corona. So the industry is currently depressed.
Now, the Hospitality Association, they're highlighting that resort destinations are known to heavily rely on traditional source markets, which are European markets. However, it appears that city hotels might be feeling the pinch as well.
Most of our city hotels rely on also quite a good chunk of people that are coming through to do business in our cities. A lot of them are reliant on what we call MICE business, which is meetings, incentives, conventions, and events. So to the extent that a lot of international agencies have cut or have actually cancelled international travel, they've cancelled international workshops, and subsequent from that, we also are suffering. Occupancies are coming down, and you'd notice that even as the HE was speaking yesterday, ZITF has been cancelled. The independence celebrations that were meant to be happening in Bulawayo have been cancelled. And at a time like this, where there is no inbound travel, we tend then to rely on domestic travel. But the impact of the measures that were also pronounced yesterday is to the effect that even domestic events are suffering, and as a result, without workshops, without those kind of events taking place.
Moving on to the energy sector, Invictus Energy, an independent oil and gas exploration company focusing on high-impact energy resources in sub-Saharan Africa, has 80% stake in the oil and gas project through Geo Associates Zimbabwe. The project is classified as a priority development initiative that can provide a significant economic benefit to the economy. It is estimated to contain 8.2 trillion cubic feet plus of 250 million barrels of conventional gas condensate across 5 horizons, while the Masasa prospect identified under the same permit is estimated to contain 1.05 trillion cubic feet plus 44 million barrels of conventional gas condensate across the 3 horizons. Now, the Zimbabwean government has established a technical committee to undertake negotiations for a production sharing agreement and held its first meeting last week. The execution of the PSA is expected to be concluded soon and will provide a stable and transparent legal and fiscal framework for the exploration and production of oil and gas in Zimbabwe. The committee includes the Minister of Mines and Mining Development, Winston Chitando, Minister of Energy and Power Development, Fortune Chassi, the Mining Affairs Board, and chiefs representing the Mzarabani and Mbire rural districts in the Kabora Basa project area. The Kabora Basa project update highlighted that the chiefs have expressed their support to the project and will be hosting a cultural ceremony to welcome the company to the community and bless the project for the upcoming exploration program. In a tweet, Invictus Energy Limited say the company and the government of Zimbabwe have made significant progress with the legal and fiscal framework that consists of amendments to the Petroleum Act and the execution of production sharing agreement between Geo Associates Limited and the company's 80% owned subsidiary, together with One Gas Resources Limited and the Republic of Zimbabwe. Now, over the past few weeks, IEL made presentations and held meetings with various Zimbabwe government ministries and stakeholders over the PSA. In July 2019, findings by a United Kingdom-based firm showed a potential of 1.3 billion barrels of oil equivalent, which consists of 200 million barrels of condensate from the Kabora Basa project. With the completion of the desktop exploratory work in 2019, the first quarter of 2020 has seen another step being made to ensure the progression of the project. Now, natural gas condensate, also called natural gas liquids, is a low-density mixture of hydrocarbon liquids that are present in raw natural gas. It is widely used to dilute heavy crude oil, bitumen, industrial raw materials, or as a blending component in the production of gasoline. With South Africa facing an energy crisis, increasing shortages of electricity and upheaval in its industry and investment, oil and gas developments are the nation's need of the hour. The aging coal-fired power plants are retiring, which translates to an urgent need of transition from gas to power to quench the regional power needs, and this project is expected to make Mzarabani the largest on-land hydrocarbon province of the African continent and provide huge benefits to Zimbabwe's ailing economy. Moving on, Sasol on Tuesday released a new plan to raise at least $6 billion. That's an equivalent of 100 rands by billion by the end of 2021. The company made the pronouncement following a disastrous share crash, and Sasol has now lost 90% of its value over the past year and suffered major losses last week after a sharp fall in the price of oil. The company, of course, is South Africa's biggest company for oil, and they are reacting to the big global drop in oil prices. Now, Sasol is also valued at only 28 rand billion by the market and sank into debt after the costs of the Lake Charles Chemicals mega project in Louisiana ran over the budget by about 50% to as much as 207 billion rand. Investors are concerned about the company's debt burden of 121 billion rands, largely built up to finance the problematic US project. It now also wants to sell assets worth 2 billion rands and is now looking for a partner in its US chemicals business, which primarily consists of the Lake Charles Chemical project. Some of Sasol's loan conditions require that its debt-to-profit levels remain above a certain level, and Sasol's profit will take a hit from the lower oil price, which will probably leave it in breach of these debt covenants, and this means that its loans could become payable immediately. Sasol confirmed that it will be able to comply with these debt covenants as long as the rand oil price is consistent at around 580 per barrel. However, the oil price is currently at just 515 rands. In its shareholder notice, Sasol intends to enhance a cash flow and reposition the balance sheet on the assumption that there is a sustained low oil price until the end of 2021 financial year. The group is planning measures to improve cash conservation and improve cash flows, which is expected to raise 1 billion rand by June 30 and another 1 billion next year. Now, collectively, these actions target generating at least 6 billion by the end of 2021 financial year. This is expected, of course, to reshape Sasol's balance sheet and provide the platform to deliver a globally competitive business with high cash yielding assets. Sasol currently has available liquidity of approximately 2.5 billion with no significant debt maturities before May 2021. The group believes it can withstand market volatility and the short term. The disruption in the global oil market, coupled with the ongoing impact of COVID-19, has significantly changed the outlook in just a few weeks, and this includes a ban on travel from various countries, as well as the closing of South Africa's 35 land ports of entry and 2 of the country's 8 seaports. In our final story, Chad and Angola have agreed on an unusual trade offer to settle a 2017 debt owed to Angola with 75,000 cattle over a period of 10 years. The sub-Saharan country is known for its rich agriculture and livestock, but is unstable because of militant insurgencies in the region. Angola, on the other hand, is rich in oil but low on livestock and drought-affected areas, and the lingering effects of the decades-long civil war. The $168 million trade-off, which is mutually beneficial for both states, will be taking effect very soon, and Angola's Ministry of Agriculture receiving the first installment of 1,000 cows, according to reports by Angola's state newspaper. And despite Angola being rich in oil, problems of drought seem to have originated from the backdrop of the civil war following their 1975 independence from Portugal. On the other hand, Chad is landlocked, a country with an abundance of cattle and oil being its top export now, hence its ability, of course, to repay its debt through barter trade. It will appear that these two nations, which are signed to African Continental Free Trade Area, have established a trading arrangement that will assist both economies greatly. That's ends the Mint today, talking about butter coming into practical terms, and of course the free trade between Chad and Angola. It has been an absolute pleasure. You've been watching the Mint. My name is Blessing Munatsi. Please do follow us on our Facebook page, Zim Papers TV Network. Our website is ztn.co.zw, and also on YouTube under ZTN. Your comments are also welcome via our Twitter handle, that's at ZTN News, and also on Facebook. Join us here on the Mint every weekday mornings, 6 a.m. Central African Time. Wishing you a profitable business day. Goodbye.